Good morning. This is Mayor Valensky with Driving Markets. Let's kick off. Let's have a look at what is driving markets today. So the GDP in the US came in at the higher end of expectations, and that drove markets down. Initially, they went up on the back of the positive economic news, showing that the American economy is expanding, is growing. I'm not 100% fan of the numbers coming out in the US because I believe that they are to a degree manipulated. I haven't got hard evidence of that, but there seems to be some sort of expectations of one number, and then all of a sudden the market is shocked or surprised when another number comes out. So the GDP came out yesterday. Now, up until that GDP came out, I was not concerned regarding any drop in financial markets throughout 2023. I'm not talking about a trading drop where there is a correction. I'm talking about a significant drop of 25 to 30%. In fact, I've been saying all along that markets will continue rising throughout 2023. When that number came out yesterday, assuming it's true, the markets got a bit of a shock and they reversed and they went down. Why did they go down? Because positive GDP under normal circumstances shows an expanding economy. However, with present inflation rates, with present wage inflation, you've got declining headline inflation, which is good, and you've got rising cost of oil, which no one seems to pay attention to, and you've got increase in soft commodities. Putting those together, you could end up with an inflationary environment. Okay. Now, when you look at an inflationary environment, that is going to frighten the Fed. So now the markets are concerned that there will be more interest rate rises in the US. Now, if there are more interest rate rises, which there could be, and at this stage, I haven't got a defined opinion because I think, as I said earlier on in my previous broadcast, you could end up with one more rate rise as a surprise in September, October, but that would be it. In light of the GDP, if that was to continue, then you could end up having rate rises go all the way through to 6%. That was my view a couple of months ago when I kept saying that by the end of the year, you probably see 6% rates in the US. Now, if that GDP does continue and does frighten the Fed, then that is going to put a dampener as far as rates are concerned, and the Fed will increase rates further. Now, when looking overall at financial markets, if that was to happen, where rates or fear of rates now come back into view, that's going to send markets down significantly. And you could be talking about a 10% fall if there is a fear of rate rises further. Talk about 10% fall in 2023. So you've got to keep an eye on a couple of factors. Number one, oil, which is a major component of the measure of inflation, has gone up over 10% over the last month or so. So now you've got a Brent crude is running at around about $83 a barrel. Now that is highest it's been in over 3 months. You've also got soft grain prices rise, but that's due to Russia banning the grain corridor through the Black Sea, and there's no agreement there. Russia could turn on the tap or turn off the tap accordingly. So you've got soft grains you've got to keep aware of. Also, wage inflation is not really going down. It's really solid and potentially could move up as the shortage of labor drives those prices higher. You've also got to look at the supply chain. The supply chain is better than it was, but not 100%. And then you've got to look at, are any discount prices or cheaper prices being passed on by the manufacturers, by the wholesalers to the retail sector. Putting that all together, I would see generally that inflation, if it stays the same, then the Fed is unlikely to raise rates. But if there's any of those move out of sync, then you could have more rate rises, and that will be more hurt and more pain for the homeowners, the businesses, car loans, credit cards, etc., etc. It'd be great for the banks because as rate rises, banks make more money. Banks are quids in or dollars in, whoever's viewing this particular channel, they're quids in when it comes to rate rises. So you'd have all the big banks making more and more money. It could put pressure on regional banks because as rates rises in the regional banks, even though they make more money, you could end up with a higher risk of those creditors or those those people who borrowed money having to pay a much higher interest rate, and therefore the threat of them going into default would be increased. So you've got to keep an eye on that also. You've got a lot of factors that's going on. Let's look at markets as where we're at. So you had a slight dollar strength yesterday on the back of those GDP numbers. Again, FX markets would see that the dollar would go up in anticipation of further rate rises. Gold is solid at 1953. One of the viewers asked me which way is gold going. Well, at this level, right in the middle, I don't know. It could go up, it could go down. I'd be a buyer at 1900 and a seller at about 2050. So it's right in the middle of the trading range. So nothing really doing there on gold. Oil, I'd be a buyer of, because I see oil creeping up to the 85 or to the 87 level in the near future, especially as OPEC, Saudi Arabia, and Russia will keep on cutting production in order to keep oil up there at a higher level. In terms of shares, well, obviously the Nasdaq shares, any threat of higher interest rates or technology shares will be impacted. Meta, which I'm not a big fan of, but what can you do? It's gone up over 6%. It's significantly beat its forecast on profitability. That is due to mainly a lot of job cuts, cutting costs, and more focus. They're still losing huge amounts of money on metaverse. Tesla still calling down to $235. It's just gone up because of the momentum of the market has gone up over the last few weeks. However, Tesla's on its reduced margins, I would call at $235 a share, those of you who are traders. Amazon, I think it's got delivery issues. I'm calling that down as well. We'll see where we go. That's more or less it. Crypto is an interesting one, by the way. Must mention Bitcoin struggling at 30,000 again. Can't seem to break above that 30,000 level. So keep an eye on that one if you are a crypto trader. That's more or less it for now. You can share, subscribe, comment, feedback. Let's get the channel going, and catch you later. Have a good weekend.